Hello, everyone. We're here for a special edition of the Financial Commute. I'm CEO Jeff Sarti. I'm joined by Meghan Pinchuk, our Chief Investment Officer. The reason for this special edition is this is the morning after the election when we're recording this. And to some degree, there was a surprise. We thought there would be a lot of uncertainty and maybe not a clear result. But now it looks like there is a clear result, and Trump did win the election. We don't know yet who's going to win the House, but it's even potentially tilted in the direction of the Republicans having a sweep and winning the House as well. Yeah. And so we wake up this morning and stocks are up. Stocks are up about 2.5%. Yeah. And so the question is it just a relief rally? And I think there's some of that. And what I mean by that is there was so much uncertainty and concern going in that the election results, they wouldn't be known at this point in time. So then theoretically the markets would be choppy along the way. But because that's not the case, there's a relief rally. So is it that, or is there different news built into the stock market that the stock market is now optimistic about certain policies that the Trump administration will implement?
I think there was definitely a lot of concern going in that it would be a long, drawn-out process, or that there would even be violence or a lot of unrest as there was last time. Yeah. So the fact that it's a little bit clearer at this point is, in some ways, the market likes certainty. Sure. So it likes that knowledge that things are going to move forward. I think there's also a lot of talk that Trump and a Republican sweep will be very positive for business.
Like in what ways?
So the fact that potentially taxes are lower, both right. Personal or corporate taxes being lower, I think could be a big positive. There's talk about,
and just real quick on that, because the likely scenario is the 2017 tax cuts that came into place. Potentially, those will now just be extended instead of expiring in 2025.
Right, correct. And so, yeah, it's less, I guess, additional taxes at this point. Mm-hmm. It's more just do the tax cuts continue out as opposed to being allowed to expire as was projected to happen in the case of a Democratic victory.
Right.
Another big one's regulation. Mm-hmm. So the idea that there will be less regulation going forward, and that's particularly positive for certain sectors like energy or financials that potentially. Is this a good thing for the stock market going forward is one of the questions being asked.
Okay, so related to that then, is it a good thing? Potentially some pro-business aspects.
Yes.
So should we lean in and invest more in stocks?
Well, there's a lot of potential negatives as well, or things that have been talked about. A big one that's gotten a lot of headlines recently are tariffs, and just the idea that will be actually very negative for the economy broadly. I think also the idea that is very inflationary, something worth exploring and talking more about. And then ultimately with valuations where they are now, there's still a lot of challenges to pair with some of the potential positives that came out of it.
So you hit on tariff, simple example of a tariff. In essence, think of it like a tax on an imported good. So let's say you were buying a widget, or let's say it's a sneaker from China. And there's a 20% tariff on that $100 sneaker. Instead of paying $100, you pay $120. Trump has been even throwing around the idea of 60% tariffs on certain Chinese goods. I mean, we're talking really potentially massive tariffs. Yeah. And the rationale around that is it will reinforce or bring back manufacturing domestically, right? Because theoretically we'll have advantages in terms of pricing power here domestically versus paying a higher price for an export.
Right. The thing that was more expensive here than in China suddenly becomes cheaper here artificially because of that tariff.
So the potential negative results, and we think there's potentially some real long-term negative results of these policies, are first and foremost inflation.
Yes.
Obviously, it's higher price goods now that you're purchasing from those countries that you're importing goods from. The second aspect is retaliation. Very natural and commonplace when you have high tariff environments is the other country will retaliate, right? And they'll place higher taxes on the goods that we are exporting to them.
Right. So now our companies that are exporting are potentially challenged. I do think there's an element here, at least some that's being talked about, of national security. Mm-hmm. So you mentioned sneakers, and that was a good basic example. There are other more essential things we need to manufacture. We need to manufacture, weapons and things that protect us potentially, or even just core infrastructure to be able to survive in environments like COVID. And so that's been a lot of the talk too. Or do these tariffs force? Yes, it pushes up cost, but is that just a higher priority bringing some of those things on shore than inflation to a large degree? Are they going to pick one over the other?
All right, so let's talk now more about inflation. Inflation has been a concern of ours for a while. It's been picking up in recent years. It's come down in the last year or so, but it's still somewhat sticky. But again, some of these policies are potentially higher in the way of inflation as opposed to lower. So what are your thoughts around that? Specifically, again, around stocks.
Right.
How will inflation impact stocks?
Yeah, I think that the tariffs in particular being inflationary, that I don't think anyone argues that point, that pushes up prices. The other big one from a policy standpoint with Trump getting elected is immigration. So the idea of he's going to really limit immigration, even he's talking about deportations. And so when you have a cheaper labor force that's coming in, that immigrants tend to be a cheaper labor force, that keeps costs low. And so now are we pushing up labor costs, and is that adding to inflation? So with all of this, though, if there are these inflationary forces, in theory, that should result in higher interest rates to help control the inflationary forces, which is historically not good for stocks. That can actually be very challenging.
And real quick, just we've even seen that in the data. In the last month or two, interest rates have gone up. Even though the Fed lowered interest rates by 0.5% about a month or so ago, most other long-term interest rates have gone up. Potentially that's because that was the market predicting a Trump win. But we're even seeing it this morning that interest rates are higher by a decent amount after the Trump victory.
And it is counterintuitive because people think of, the Fed, what is the Fed going to do as it relates to rates? The Fed only controls short-term rates. So they get to set the short-term rate, but the market dictates what long-term rates are. So to your point, even though the Fed has brought rates down and even talked about bringing rates down further, with all of these inflationary pressures that are out there in the market naturally, we're seeing interest rates rise as a response to those.
So we talked about tariffs potentially negatively affecting stocks. We talked about inflation and or interest rates. Also, do you want to just quickly mention valuations? We still are in an expensive market.
Right, we're the highest we've been from a valuation standpoint since 1999, and the reality is again that with all of these challenges out there, when you add that on top of it, right, it's sort of the cherry on the cake where you're already at expensive levels and you have all of these challenges and uncertainty. Does that create just a more volatile environment for stocks potentially?
Potentially. So there are potentially some pros, again, as you mentioned, pro-business related outcomes. Lower regulation, maybe again lower taxes, but there are potential some offsets to the tune of inflation, interest rates, and tariffs.
Yes,
and valuation.
And another big one, something worth talking about, is the uncertainty around some of the potential policies coming out, and some of them being the potential to be fairly extreme as well.
Yes. So Trump, leading up to this election, was talking about a number of initiatives that he's going to potentially try to push forward, and who knows if these will come to play or not.
I know in election cycles, obviously there's a lot of big, bold statements made. So which of these come to fruition?
Like one extreme example, for instance, as he's talking about tariffs, he's talking about offsetting that with the elimination of income taxes, as an example. Now, realistically, is that going to happen? I would say very unlikely. That being said, again, maybe movements in those directions, at least partially, especially if they do win the House. They've already won the Senate. You don't know what policies can drastically change from an income tax point of view.
Right.
You mentioned the border. Border is a big issue, right? We talked about potential massive deportation of illegal aliens. Geopolitics, always a wild card. So much now on the geopolitical front in the Middle East, Ukraine, Russia, China. Again, the unknowns are pretty extreme. So given all of that now heightened uncertainty, we're now talking more from a longer term point of view as opposed to the short term. What are your thoughts on that around constructing portfolios?
Well, I think that we need to be prepared for that, right? For the uncertainty. We need to create resilient portfolios, which we've been pretty consistent about talking about, because on top of all of this, also there is the fact that the debt is going to keep increasing. And so that's something, though, that, to be honest, wasn't really impacted that much by yesterday's results because...
Yeah, what do you mean by that?
Well, regardless of whether Harris or Trump won, I think that the consensus was that the debt levels would be going up. So we're going to keep spending as a country. We're not going to be cutting back on what we spend. So the reality is that will keep increasing, and that's also an overhang on assets. So what do you do in this environment? Again, it's the same thing we've been doing, which is you lean more heavily into real assets, so into real estate, into gold, private lending in particular, where you can make currently, I think, what we feel are very attractive yields, and you're getting paid very well, almost equity-like returns for more bond-like risk. And so those kinds of things where you can stay ahead of inflation, having layers of those in the portfolio on top of, look, stocks could continue to run. Sure. It could be very positive for stocks in certain ways. So you need to have that true diversification, that mix of different kinds of things that could behave differently in various environments.
And one potential benefit of our related to our private lending strategies, you mentioned interest rates. If interest rates coupled with inflation do move higher, that could be a net benefit to our private lending strategies as well, right?
And that's the question. Do you have things in the portfolio? There's stuff in the portfolio, things like stocks where potentially high interest rates are negative for those assets. But there's others where if you have floating rate bonds or loans or very short-term loans, as we're more positioned that way, it actually could be an advantage if interest rates go up. So it needs to be where interest rates going up as just one example of a potential event doesn't take down everything in the portfolio. Sure. So that's why, again, traditional diversification where I'm going to have my stocks, I'm going to have my bonds, it doesn't work the same way it used to, where the bonds would be a ballast. Now interest rates go up, bonds go down, it could be bad for stocks also. So you have to have other things in there that are going to really drive returns.
And again, to repeat what you said around the debt issue, this is an issue we've been talking about now for a number of years. It's something that's very top of mind. And so much of what the media at large is going to be focused on are short-term issues, things around regulation, taxes, the border, et cetera. And those things are very important. I don't want to imply that they're not, but the large overhang that we're facing around debt levels is extreme. It's something we talked about for a very long time. And the challenge with the Trump presidency is he's not a classic conservative in terms of austerity and reducing spending. And that showed itself, that displayed itself in his first term, right? Deficits were really high, even pre-COVID. He was spending a lot of money.
Yes.
Deficits and debt levels were increasing. So because of that reason, it's something we're continue to be focused on and focused on real assets, private lending, gold, et cetera, to combat those forces.
Right? Yeah, I don't think there was any question in terms of either party having sort of the political will to take on something like the deficit. So at this point, again, it's less about will that come down, right? What will ultimately happen? We know the direction that is headed. So with that information, how do you protect yourself in that environment? And so I think we've got some good tools and some good options.
Interesting times. Listen, we're obviously going to be spending a lot of time thinking about this, adjusting portfolios as policies change. But for the time being, we think we have really resilient portfolios and we're in a good place. So with that, enjoy the conversation, Meghan. Thanks.
Thank you.